Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and I hope everyone is doing well here this afternoon. If you can hear me loud and clear, can you please type yes into the chat window, which you can bring up at the bottom of your screen? Okay, perfect. I see a lot of yeses. Great. Let's go ahead and get started. Now, today is going to be part 3 of our intermediate options trading course. Now, many of you may have joined us for part 1 or part 2, but if you have missed it, I highly recommend that you take the time after today to go back to the recordings. We will send you both the recording from today after we finish, as well as the recordings for part 1 and part 2, where we reviewed during part 1 about entering orders for options, talked a little bit about position management, how to make sure that you think about managing your positions when it comes to options. We talked a lot about liquidity on that webinar. A lot of people learned new things regarding how to determine whether an option is liquid or not. We talked a lot about open interest and volume and liquidity. So there were a lot of things that many of you that I feel, especially if you are relatively new to options trading, and even for many of you that have experienced options trading, seem to have certain views as to liquidity. And I dispelled some of those myths in part 1. So I think it's really important to review that. And then a couple of weeks ago, we talked about optimal expiration dates and strike prices, because when you're trading options, you are using a page that looks like this many times, an options chain that has all the calls on the left, the puts on the right. You have all the expiration dates, all the strike prices. And many times it can be quite confusing as far as where do you select the optimal expiration date, whether you're buying an option, whether you're selling an option. If you're trading a spread, how do you determine the strike prices? There's a lot of work that goes into that. Many times as an experienced trader, you just learn different patterns as far as how do you go about selecting expiration dates and strike prices. So we talked about some of those overarching theories as far as how do you go about selecting expiration dates that work in your favor or put the edge in your favor, and vice versa. If you're selling options, how do you choose specific expirations and strike prices that give a little bit of an edge to you? So we discussed those things on our webinar a couple of weeks ago. So today, what we're really going to do is start off with a brief market overview, just to give you a sense for where we're currently or how we're looking at this current market. And today is really a day to provide you guys an opportunity to ask questions, to take what you've learned over the last few weeks and ask us how you want to apply it to the real markets. I will start off with a few examples and then open this up for Q&A and open it up for you guys to submit symbols that you want to take a look at, submit some strategies that you want to take a look at, and we'll do it all together. And this is really designed to be more of an interactive learning experience rather than me teaching you something. And we want to do these every few sessions so that you guys have a opportunity to take what you've learned and ask questions before we move on to the next topic. So those are the things we're going to go over here today. Now, before I do, just a quick disclaimer: what we're going to discuss here today is purely for educational purposes and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. And for those of you that are brand new to OptionsPlay, if you have not already signed up for it, you can register for free using this link on your screen, which I will post into the chat window. This will give you access to the tools that I'll be showing you here today, as well as access to options education, the video library, the cover call and short put reports that are now going out Monday, Wednesday, Friday to your email inbox for those of you that are generating income using cover calls or cash secured puts. Those reports are now updated daily and they're going out to you Monday, Wednesday, Friday, so that you can continue to make sure that you have access to the reports that give you the opportunities to generate income for those of you that are interested in cover calls and cash secured puts. So this is all available to you free of charge, courtesy of the Montreal Exchange, by signing up using the link on your chat window if you have not signed up already. So let's go ahead and go over today. Is, like I said, is going to be our live analysis with the Q&A. I'll start off with a little bit of where we currently see the markets, specifically the Canadian markets. Then, like I said, what we did is we covered option orders, order entry, for those of you that are newer to options trading, it's important to understand how order entry differs between stocks versus options. And we talked a little bit about position management. And we have optimal expiration dates and strike prices, which is what we covered last week. So anything related to those types of topics, please think about what questions you might have. We certainly will be able to present all of those to you. Now, many of you did attend our options education day on April 27th. If you attended that, please type yes into the chat window if you attended the options education day. Okay, great. I see a lot of yeses. So for all of you that attended, I don't know if any of you have watched the recordings, but they are also all available to you here at this link on your screen. So I will post this link to you as well. For those of you that either missed it or watched it, but only watched a portion of it and you want to review it, you can watch all 4 hours of programming that we did that day from all 4 speakers. As far as different topics on how to trade options, I covered how to trade earnings utilizing options. Luke and Patrick covered some of the basics regarding options trading and Greeks and how to select strategies. And lastly, Chris from Odin Brown covered income generating strategies, selling covered calls, selling cash secured puts, as well as some collar strategies on protecting your portfolio. So a lot of great content for those of you that are in the process of learning how to trade options. That options education day was a fantastic event, and I highly recommend you to watch that recording at your own pace for those of you that are still in the process for learning how to trade options. So with that, let's go ahead and start off by talking a little bit about the live market analysis with right now as far as how we currently see the markets. So what I'll do is I'll start off by looking at the XIU chart, and I'll give you a sense for, on the left-hand side here, what I have is the weekly chart of XIU. On the right-hand side, I have the daily chart. So the weekly chart, to give you a sense for how we're currently viewing the markets, we obviously had that very strong downtrend during the COVID-19 sell-off. We have now rallied back roughly about 60% of that initial sell-off. Over the past few weeks, XIU has really struggled here around this 20-week moving average. And when I say struggle, meaning it has battled it out between bulls and bears in between this $21, $23 level for quite some time, $22 and $23 level for quite a few weeks without a clear determination as far as a winner. But the fact that it's still below the 20-week moving average tells me that the bears have a little bit more control here, unlike in the US markets where the bulls have started to reclaim some strength, and we've been seeing over the past few weeks some higher highs. But as you zoom into the daily chart here for XIU, as you can see, we managed to make it back up above 22 here on April 24th. We had initial nice, let me move this back down. We had an initial nice move from 22 all the way up to a little over 23. But over the past few weeks, it really has been range bound between 22 and 23. Now, what I want to point out here is that as the markets have kind of moved sideways and we've had a pretty choppy trading session, momentum is starting to move lower here. This is telling me that this is not confirming any moves higher, and that there's starting to be some momentum for it to roll over. Now, it doesn't have to roll over far. It could just go down to about 22 or so and then continue moving higher. But we are at the current moment missing the type of bullish momentum we're looking for that we have seen here in the US markets, where over the past few weeks, last week, the US markets made it to a new relative high. Canadian markets did not, so it's certainly lagging behind, and momentum is starting to look a little weak. Money's flow on the weekly chart also looks relatively weak. So meaning there's not a lot of support for this move higher. And as you can see, you have the 20-week moving average at about 23, and then you have the 200-week moving average at about 23.50. So you have some major resistance levels here at 23 and 23.50. 24 is really the gap fill for this, when the market gap lower from 24 all the way down to about below 23. You have multiple gaps. The first one was filled. The second one still remains unfilled. So that may be that may be the target to the upside if it does break out to new highs, is to fill that $24 gap and see how the markets react to those levels. So that's how we're currently looking at the markets. Like I said, the bears still have a bit of control here, but basically with the US markets being so strong, I do think that the Canadian markets are going to find a little bit of support as a result of that. But as I said, momentum is starting to decrease a little here, and I'm watching this double top here at about 23.30 or so. It really needs to make a break above that to get back to 24, 24 and a half. Those are the levels that we're really keeping an eye out for. But like I said, you have a major 20-week moving average here and a 200-week moving average. Those are going to provide some resistance levels. And then once it gets back to 24, that's really when I would say that we're back in more of a bullish territory now as far as the Canadian markets go. So that's just a quick overview as far as where the Canadian markets currently are trading, especially for those of you that follow the US markets and you're familiar with what's going on there. It's also important to understand that there is a little difference here, that the Canadian markets are not as strong, at least technically at the moment, and there is some major resistance level above that's going to provide a bit of, I would say, difficult time for bulls to continue to take control of this market. So that's how I'm currently viewing the Canadian markets. So at this point, what I'll do is I'll open this up for any symbols that you guys want to take a look at specifically within the Canadian markets, and any questions that you might have from the last few weeks with anything regarding the US based, anything that you have regarding the optimal expiration dates and strike prices, as well as your questions regarding entering option orders. I know there were a lot of questions around liquidity during that session, so I want to make sure that we take some time to address any of those if any of you are still if you have questions on those. And Tony's saying one thing about the reports are only for Canadian companies, not US. So Tony, we also have US reports as well, but you do have to sign up for the US version of OptionsPlay, which you can go to at optionsplay.com. You can sign up for a free 30-day trial there, but we certainly do have those reports for US companies as well. So let's see, I got a couple of questions here and I got a couple of symbols to look at. So let's first answer a couple of questions and then I'll come back to these symbols here. So if I initiate a vertical buy and sell for a month from now, can I keep the stock if I want? How do I close it out? So first of all, when we talk about a vertical does not have any stock legs involved. So there is no stock that you can keep even if you wanted to. If you exercise one of the legs, then certainly you can keep on to that, keep the stock leg of the that you exercised. However, you generally will close out any type of vertical spread as a whole strategy, meaning if you enter the spread, this 44.48 call vertical, you would close it as a $44.48 call vertical. Even though they're two separate legs, you should think of them as one single strategy. So you would enter as a single strategy and you would exit as a single strategy. So that's generally how those are traded. I expect the TSX to be up and down for much of the next 9 months. I'm interested in buying XIU calls for 11 to 12 month expiry. Would you please bring up XIU? It looks like there's very little interest in this kind of play, hence the wide bid-ask spreads. So, I mean, as far as XIU having wide bid-ask spreads, you know, if we go out a year, let's say we go out to March 2021, which is roughly 1 year out, you're saying that there is very little open interest, but this is one of the things that we discussed last week, is that open interest really means nothing. XIU at the end of the day is the S&P TSX 60 ETF, which as an ETF is pretty liquid. You know, look at this, you have tens of thousands of open interest contracts, even going out to March 2021. So I would consider any of these very liquid in my opinion. And the thing is that a lot of people tend to somehow think that the strike with 22 contracts is somehow less liquid than the strike with 5,300 contracts. And the answer, and the reality is that that's not true at all. That just means that a lot of people bought the 22s versus 21s because 22s is a nice even number and 21s is not a nice even number. And you tend to have just people trade more even numbers, generally speaking. If you see liquidity, they tend to pool around even numbers. Are the even numbers more liquid than the non-even numbers? Absolutely not, especially in this day of electronic market making. To a market maker, none of these strikes make a difference. Whoops. To a market maker that's making a market, he doesn't care whether he's making a market in a 15 or 19 or 27. To a market maker, the liquidity is the same, because guess what? He has to hedge himself by selling XIU stock or buying XIU stock. So for him, it doesn't matter what strike he's making you a market in. He just has to buy XIU. And so whether he's making the market for the 15s or the 22s has nothing to do with liquidity. So that's my comment on liquidity. Regardless of how wide the bid-ask spreads are, if you look at executions on XIU, I guarantee you that they're traded very close to the midpoint, and that's how you should think about trading these. And also the at-the-monies usually have much tighter bid-ask spreads, but this is one of the things that we covered on our first part one, is the fact that bid-ask spreads don't mean too much. You should always put your orders near the midpoint and work your way out from that midpoint, but you should get filled well before you get to that bid-ask quote. So the bid-ask quote is just what the market maker is asking for. It doesn't mean that that's what you have to interact at. So keep that in mind when you're trading these options. I hope that answered your question, Maurice. So Wallace wanted to take a look at Enbridge. Now, Wallace, one of the things I will say is that if you want to submit a symbol, please tell me whether you're bullish or bearish on it, so that we're looking at it from the same eye here. So when I look at Enbridge, which is an energy company predominantly in the natural gas space, the chart here looks fairly constructive, but I will say, in the backdrop of where the energy markets currently are, I'm not particularly strong on the energy markets. But just looking at this chart, one of the things, and this is the same for if you look at any of the energy names or energy sectors, if you will, you have this large gap here around 48, and you can find this type of gap in almost any of the current energy companies. And you have this kind of large, I would say, basing formation, right? Bottoming formation, where if you would target to the upside, if I was looking for a bullish move, I would target this $48 target. Can it get above 48 and go higher? Perhaps. I'm a little concerned as far as whether energy can have that kind of momentum to continue, because I think a lot of this right now is based on a slowly decrease in terms of supply rather than an increase in demand. So I do think that you might have a small move to the upside. So something like a vertical spread is very suitable, in my opinion, to take this type of trade where you're risking a relatively small amount of capital here. So $150 on a $44 stock is 1.5 divided by 44. You're only risking about 3.5% of the underlying stock price to make a bullish bet that Enbridge will, let's say, go up to around 48 or so. And if it does move up to 48, here you make 166% return on your $150 investment. That's the type of risk reward that I would look for on a trade like this. I don't think that necessarily that this could go much further above 48, but I don't know the specifics about Enbridge, which I do think is a little different than most of the other gasoline or shale producers. But I don't know specifically too much about the company, but from the chart perspective, it looks very similar to a lot of other energy companies. I think that there could be enough momentum to get up to 48, but if you do get this start to roll over, I'm only risking 3.5% of the underlying stock price to take that type of bet. And if I am right, I make 166% return on my capital. So that's a type of way that I would utilize options to try to take a bullish view here on Enbridge. Boris wanted to take a look at TD. Now, Boris, if you can tell me whether you're bullish or bearish on TD, that would be great. But let's just look at this. TD, whoops, this is still Enbridge. If we look at TD, my view on the banks is not particularly favorable. The banks have really the only sector, even the energy sector has started to climb back a little bit. Banking has really been predominantly of one of the weakest sectors, despite finding a fairly attractive 5.5% yield. And we feel that that yield is fairly stable, meaning we don't think that there's a lot of risk of that dividend being cut. But still, even in that type of environment, with yields going to zero, I think at best you might get a move up to about that $60 level, but likely that you are going to retest that 55, or I'm sorry, $50 low to the downside as far as TD here. I would be more inclined to take a bearish view. I'm curious as to hear your views. Boris says he's bearish. So, okay, so if you're bearish on this, looking at strategies like a put vertical makes sense if you do think that it's going to make it down to about 50 or so. The other way that I would play this in terms of TD is, as far as it's hard to continue to short. It's hard to short a market that is still at this point moving higher, right? Both the weekly chart and the daily chart clearly are trending higher. It's many times that's not the best environment to outright short, even a weak sector like banking. So one of the things that I've been doing in this type of market environment for banks is really selling premiums, selling a call vertical here. So I might sell something like a $56, $60 call vertical where even if banking doesn't decline, I can still make a profit on this type of strategy. So as long as it doesn't rally, as long as it doesn't do this, as long as it doesn't do this, selling a call vertical may be a better strategy here than buying a put vertical, which requires the stock to make a move to the downside before you have a profit here. So, the stock would really have to go down to about 51 or so for this type of strategy to be worth my while. And sometimes, as far as the banking side, they do have a pretty strong dividend. And there aren't a lot of catalysts here, in my opinion, that can really move this stock significantly lower. TD here does report earnings here in 3 days, which could be your catalyst. So if you are looking for that catalyst move, then buying that put option may be worth it, and you think it's going to revisit 50. But if you think it's just going to stay around here and like trade range bound between 50 and 60, you might want to consider selling some premium instead of buying, so that as long as it stays here or moves a little lower, or maybe even moves a little higher, you can still make money from a strategy like this versus buying a put requires a substantial move to the downside. So hopefully that answered your question here, Boris. Let's see. Wow, a lot of questions here. Let's try to get through some names quickly, and then let's try to get your views here. So I hope that answered your question, Dwayne, as far as what my thoughts are on Canadian banks. VET, I'm not familiar with VET. This is an energy stock. So I would say this chart looks very similar to Enbridge, just slightly different levels here. The levels here is around $10 or so. You have this potential breakout to fill that gap. Same thing, but as you can see, the options here are clearly more expensive. So I would say that, Enbridge looks significantly stronger than this particular energy company per se, but I don't know much about this specific energy company, but I will say they are very similar. Someone's asking for Canadian Imperial Bank, which very similar to the TD chart, and my views here are exactly the same here as far as a stock here. I think financials are going to have a tough time, and this is purely just a rates play. With rates going to zero, these banks are not going to see a real reason to rally, especially if you consider the fact that there are potential loan losses coming down the line as some of the economic numbers come out and they're quite terrible. I think the risk at this point are skewed to the downside for most of these banks. Unless they can provide some kind of really positive guidance in the next few days during their earnings, which it's possible. I think that that's less likely here. And my positions that I personally have in banking, they're not Canadian banks, they're U.S. banks. Specifically, some of the U.S. banks that are weaker have been, again, selling premium here because I don't know that there's a strong, I would say, catalyst for these stocks to make a big move to the downside. But I think that they could drift a little lower here to the downside, and that's why, again, my preference is to sell premium, because as long as the stock stays where it is or moves a little bit lower, I'm able to be profitable. And even if it moves a little bit higher, I can still at least not lose money. Versus here in the put option, the stock would have to move a significant move to the downside in order for it to be profitable. Richard's asking, are there any circumstances where you might exit a cover call early? Yes, so there are certainly cases where I would exit a cover call early. Let's say when Canadian Imperial Bank was trading at, let's say it was trading at, 107, and I sold the 110 calls. And a week later, the stock was down at 104. 2 weeks later, the stock was down at 104. And I thought there was no way the stock was ever going to make it back to 110. Then yes, and let's say, especially if let's say I still had a few more weeks left to expiration, I would exit that call early. I would buy back that 110 call, which at that point would be close to worthless, and I would sell maybe a 107 or 108 call and collect a little bit more premium. And if the market kept going lower, I can continue to exit my cover calls early and collect more premium. That's an example of some time where I would exit a cover call early. Ed is saying, on the left side of OptionsPlay, where do the trade ideas come from? The trade ideas are based on technical scans. So these are based on technical analysis scans. So if let's say we click on Bearish Gold, it'll tell you what the indicator was. So the CCI bullish crossover. So as you can see, the indicator went below the threshold level and came back above it. That's what generated the buy signal on this particular name. So you can actually see what technical indicator generated the actual buy or sell indicator when you click on the name. GLD bullish. So I'm not here to do US based symbols, but if you take a look at Bearish Gold, which is a gold mining company, these are kind of leverage plays on gold. I certainly am a big fan of these names. I actually have a position myself in one of these gold miners, as opposed to GLD or gold itself. I have a bullish position in one of these gold miners. I also think options here make a lot of sense because these are leverage plays. These types of stocks are very volatile. You could have a very quick pullback down to that $30 level. You don't want to take on a lot of risk if it does happen. So trading a vertical like this, where you're risking $255 on a $37 stock, it's not cheap, right? $2.55 divided by 37. You're risking almost 7% of the underlying stock price, but you are limiting your losses to 7%. These types of stocks can move quite a bit. As you can see, it went from 29 down to 18 in the matter of a week. So, you have a lot of downside risk in stocks like these. So I always want to prefer to take a bullish view using strategies like this. This gives me almost 2 months of upside here, out to July, 53 days. So if gold does break out and Barrick Gold breaks above 40, this type of strategy is the strategy that gives me relatively good risk to reward for the type of bullish outlook that I might have or you might have on GLD. Bearish on CIBC and other banks, that's exactly my view, and I think I went over a few different ways as far as how I would do this. CNQ. So what's your view on CNQ, Karun? Canadian Natural Resources. This chart looks very similar to, the Enbridge chart. I will say this chart looks a little stronger from the perspective of you do seem to have very clean, higher highs, higher lows, and it's certainly seeing a lot more strength than some of the other energy stocks. But again, I think that the limit here to the upside is roughly about $30 or so. So you still have a little bit of room to the upside. Again, my strategy that I would prefer on this type of trade would be utilizing a debit spread here. $1.61 on a $1.61 on a $25 stock is roughly 6.3%. So I'm risking 6% of the underlying stock price on a pretty volatile stock. So risking 6%, in my opinion, is a fairly reasonable amount to risk to play for this stock to reach back up to 30. As you can see, if the stock does reach 30, you're looking at about a 200% return on your $161 investment. Energy is certainly a very, I would say, difficult sector to be making investments right now, given the economic backdrop. I think that you have a strong possibility that something geopolitical around the world happens and the stocks drop, and you want to make sure that when that does happen, you are limiting your losses. And using a vertical like this is one of the best ways to limit your losses, because if you just bought a call option, you would be risking $1.86 on a $25 stock, which would be 7.4% versus 6.3%. So you're risking an extra 1.5% just by buying a call option as opposed to selling that vertical spread. Mohammed, you have a lot of names, but I think most of those names are US names. So if you don't mind, we're keeping these two Canadian companies here today. let's see. PPL, bullish. Is this a, yes, it is an energy company. It's a pipeline company. Those certainly have looked a little stronger. Pipeline, as you can see, we still have that gap here around 45 or so. You know, this chart also looks somewhat constructive because it is making higher highs, higher lows, and it's making a new high here over the last week, right? So, you know, again, these types of plays still somewhat quite risky in my opinion, but I would still use vertical spreads here because $2.15 on a $35 stock is risking 6% of the underlying stock price. You know, can you sell some premium as well in these energy names? I certainly think perhaps you can. I haven't looked very heavily in some of these names yet, but something like selling a $34, $32 calls put vertical here, nah, you see, that doesn't work. You're only collecting 40 cents on a $2 wide credit spread. That's not enough credit. You're only collecting about 20% of the width. Normally you want to collect roughly about 33% of the width. So you usually want to collect roughly about 66 cents, 67 cents on a $2 wide credit spread. Here, you're only collecting 40 cents. So the only strategy that I think I would take here is buying a call vertical because I'm risking a relatively small amount of capital to try to play for some upside. So a lot of common themes here, right? I think pretty much the two common themes I'm hearing across from everyone is that you're generally bearish on banking, you're generally bullish on energy stocks. So, you know, I'm laying out how I think I would be playing these types of names. I don't think I myself have any, no, I don't have any long energy positions just because it is the weakest sector, and it's just not a sector that I generally play a lot in, but I certainly do have some bearish bank names in my own portfolio, and I've utilized options for those strategies, and I've sold premium here as opposed to bought premium. For those of you that watch Options Action on Friday on CNBC, we actually talked about taking a bearish view on financials. Mike laid out a trade on his as far as how he would trade, and he used a put spread, buying a put spread. But I just laid out to you why I think that the better strategy here is to sell call spreads, because I don't see a strong catalyst. But those are for the US banks. The Canadian banks report earnings next week, so that you do have a catalyst. So for that, you may want to buy those put spreads, because if you think that earnings announcement is really what's going to cause these stocks to drop back down a few percentage points, then buying a put option may be suitable here. You are paying quite a bit, $3.58 for a $56 stock, which for a Canadian bank is risking 6.3% is a lot, because these are significantly less volatile than energy stocks. You know, most of the energy names that I just showed you were risking 6-7%. Risking the same amount for a Canadian bank, in my opinion, I think that's quite a bit to be risking. Selling a call vertical is the strategy that I was looking at predominantly for these types of names. Selling something like a $50, $60 call spread, risking 240 for 160. But if TD doesn't make a big move to the downside, you can still make capital. You can still make a profit, versus if you bought a put spread and the stock didn't move, you would lose a significant amount of capital here. So that's the two general themes that I seem to be hearing here today. But let's keep looking at some other symbols here. Here's a question: how do strategies differ from weekly options and monthly options? Great question. So the question was just, you know, how do weekly versus monthly options differ? So as you can see, all of these that have a W are weekly options. The non-W ones, like this June 19th one, has no W. That's a monthly option. The answer is they are exactly the same. It's just a matter of whether they expire on the third Friday of every single month, or they expire on a different day of the month. From an options perspective, they are identical. For those of you that are concerned that the weekly options have smaller open interest, I'm telling you, they are not any less liquid than the ones that are monthly options that have more open interest. Because again, to a market maker, it doesn't matter to him if he's making a market for a 5-day option or a 15-day option or a 30-day option. It's the same models that he utilizes to make those markets. There's no preference in terms of liquidity. So don't worry about whether you're trading a weekly or a monthly option. Choose the expiration date and strike price that suits your thesis and your time horizon. So if you're bullish over 3 weeks and you want to trade an option that just happens to be a monthly option that suits your time frame, go ahead. But if your time frame happens to line up with the weekly option, trade those. There's no difference from an options trading perspective between weekly and monthly options. It's just what we call them. From an options trading perspective, they are identical. I hope that answers some of your questions or concerns about trading weekly versus monthly options. Why don't companies like CSU and Shopify have options on the Canadian markets? Claude, I really couldn't answer that question for you, unfortunately, but I think that that's a question for the Montreal Exchange. If you find that those are actively traded and you want options on them, I actually think that Montreal Exchange would love to have that type of feedback. I actually thought Shopify did have options, but I could be wrong. And you guys know this. Shopify does have options on the Canadian markets. I don't know the other company, CSU. CSU. If anyone knows what CSU is, I'm happy to look that up. But Shopify does have options in the Canadian markets. Let's see. Wow, a lot of questions. Let's try to get through as many questions as I can. Put credit spreads. How do they expire or how to close? Well, it doesn't matter what type of spreads, you know, or it doesn't matter what type of spread you have. When you say how do they expire, I'm not sure what you mean by that. All options will expire at some point. As far as closing it, the best thing to do is call your broker, because each broker does have different user experiences as to how to close out a spread. So I would contact your broker and have them walk you through it. That would be the best way to do this. Are there circumstances? Oh, we've already answered those questions here. Great West Insurance, bearish. Okay, I'm not sure of this company. Great West Insurance, GWO. So, okay, so the insurance company is very similar to the banks in terms of charts, but this one looks even weaker here. You know, most of the other banks have kind of traded within a range. This is traded within a range and is starting to break to the downside here. So certainly, I think more on the bearish side here, very weak relative strength. So generally speaking, I do find that when things are pushing this weak, that sometimes it's difficult to continue to push for shorts, because I do think that you've missed most of that. At this point, the fact that it's already down, you know, roughly 34 to 20, you're down, you know, well over 33%. You're down almost 40% on this. You can continue to push shorts, but I think you are, you have a high risk of the stock, you know, bouncing higher on some good news. So for those types of names, very important that you use strategies like a vertical put spread, where you are risking a very small amount of capital to do so. Unlike some of the other banks that have shown a bit of strength, you know, you're looking to fade some of that strength. Here, this is a stock that's already near its absolute bottom. So probability-wise, I think you have a higher probability that some good news comes out and the stock jumps higher than for further bad news and for the stocks to jump lower here. So because of that, I would prefer to use strategies like a vertical put spread that limit my risk. Everything here is about limiting risk. Anna wants to take a look at SAP. SAP, are you bullish or bearish on that? If you could please let me know, that would be great. So I don't particularly have a strong view here, but SAP did trade in a pretty tight range here for quite some time. It looks like it's just starting to break to the downside. So perhaps more of a bearish view here, down to about 33. You know, you had this nice little rally into this range and then traded within that range and is starting to break lower. So, you know, this type of trade, you have a pretty, I would say, clear target here, probably down in the $30 zone. And I would definitely use more of a put vertical here, in my opinion, because you're risking a relatively small amount of capital, $130, 1.3 divided by a $33 stock. You're only risking less than 4% of the underlying stock price to take a bearish view here on SAP. this way that if you do have some good news that comes out and this trade turns out wrong, you're only risking 4% of the underlying stock price to take that bet. So that's how I think I would play SAP here. Let's see, TELUS, telecom stock. You know, the US telecoms have been doing okay. You know, TELUS obviously being one of the largest ones in in Canada in terms of telecom. I will say that, you know, the chart looks somewhat constructive from the fact that you have this triangle. You have higher lows and potential breakout to the upside. I don't have a directional view, I will say, but just looking at the chart, you are having a slightly more constructive bullish, I would say, setup here than a bear setup, especially if it can break back above 23.5, which is a major hurdle for it to get above. But if it does get above that, I think you have what could be a rally up to this $26, $27 level, which is that last gap lower here. So I think you have a little bit of upside, but I do, in my opinion, want to wait for this stock to break above 23.5 before to go long. And once you get that, you know, call options here are actually pretty cheap here. You can use a July 22.25 maybe, or 22.25. Oh, the 25s really don't provide much premium here, which is why by default we couldn't find you a strategy. Just buying a call option here is quite cheap. 85 cents on a $22 stock is roughly only less than 4% of the underlying stock price to buy a call option here. You know, that's how I think I would play something like that. Someone wants to take a look at Franco-Nevada. I will say Franco-Nevada very similar to Barrick Gold in terms of I don't know the Nevada, is it FN? Oh, it is the same for the US. I would say a stronger chart looking than Barrick's Gold, which has been kind of sideways for the last few days or last few weeks. This chart continues to make higher highs and higher lows, which is certainly a bullish view. And as you can see here, I can buy a call spread here for $8.90. $8.90 may sound like a lot, but it's a $210 stock. So you're only risking 4.2% of the underlying stock price to take this bullish view, especially with these types of gold mining stocks, which is kind of a leveraged way to play gold. You have a high amount of risk that you do get some severe pullbacks. You know, gold is susceptible many times to some very short-term shocks to the downside. So these names will actually fall even further if you do get that. So my preference whenever I trade any of these types of names is to make sure I limit risk. And the best way to do that is using these types of spreads here. Donald wants to look at KXS. I know nothing about this stock, but it certainly looks like a very strong stock. I don't even know what sector this is in. You had a recent consolidation in this one. Let's just zoom in a little here. Whoops. You obviously had this strong breakout here. You had a bit of consolidation here between what looks like around 150 and 170 or so. It looks like it's just breaking up to the upside. So certainly very bullish here. Now it does seem like there's a list, they only list strike prices up to 180. So you're limited here on using the July options. If you go out to October, you could buy a call spread here, something like a 175 to 10 call spread for 945. Again, I know nothing about this stock, so it's really hard for me to comment, but you do have a really nice breakout to the upside here today. You might want to play this as a breakout play, but again, using a type of spread like this makes, in my opinion, some sense. $9.45 on a $178 stock, you're risking 5.3% of the underlying stock price using a strategy like this. Options are relatively cheap, I would say, for a name like this, which looks like it's a fairly volatile stock, but again, I know nothing about the stock, so hard for me to really make any comments on that. Hermont is asking, what does the technical score imply? The technical score tells you the relative strength of the stock compared to the rest of the market. So as you can see, looking at all the charts that we looked at, this is probably the strongest chart of any of the stocks we looked at. That's why it has a score of 10, because it's outperforming pretty much all of the other stocks in the market. You look at some of the other names that we looked at, GWO, which was probably one of the worst looking stocks, near its absolute lows. That's why it's got a score of 1, telling you it's underperformed pretty much all the stocks in the universe. And then if you look at a stock that's maybe, let's take a look at some stocks in our watch list. Let's say you take a look at like Canadian Natural Resources. This is sort of middle of the road. That's why you have a technical score of 5, telling you that about half the stocks in the market are outperforming it and about half the stocks are underperforming it. So it really gives you a sense for how a stock has performed compared to the overall market, and giving you a quantifiable way to sort a watch list so that you can know which names in your watch list are the weakest names, probably better for a short candidate, and which stocks in your watch list are the strongest names, probably better for a bullish candidate when you're looking for ideas. Okay. Do you sell both options at the same time at market value? If that was a question regarding closing a position, then yes, you would close out both positions. You wouldn't necessarily be selling, because one would be buying, then one would be selling, but they would be both to close, and you would sell them at the market value, what they're currently trading for. Yes, or you can place a limit order if you have a specific price that you want to get it at, so you don't necessarily just have to pay what the market is offering at the moment. You can put in an order and put in your own price and wait for the markets to come to you. I have a question. The banks report earnings soon, and the mortgage deferrals do not start until April. The earnings quarter is up till March. Do you think banks will report less earnings for this quarter? That's a very specific question regarding Canadian banks that I'm just simply not primed for, unfortunately, Preet. I simply don't know enough about Canadian banks and kind of where they currently sit to be able to comment on that, unfortunately. So I'm sorry, I don't want to speak out of turn here. If you initiate a spread straddle strangle, how do I have to close it together? So you can certainly close them individually, but I think that you might find yourself, well, I guess it depends on what you have left with and what your bank or what your broker allows you to trade, right? Because if you trade a spread and you close out one leg and the other leg that you're left with is a short leg, you might have a margin requirement on that, or your bank may not allow you to have a short option position naked like that. So really, it's up to your trading experience and your trading level and what your bank allows you to do. Generally speaking, with those types of strategies, you close them as a single strategy. You do not close them separately, leg by leg. I moved the bottom of a collar to break even at a large debit. I feel that this was a mistake in changing strategy. Anything to do or now wait it out? So Rick, unfortunately, you're gonna have to give me a little bit more information on that. If you want to send me an email at info@optionsplay.com, I'm happy to take a look at that and give you a little bit more feedback. I'm bullish on OGI. Can you bring up that symbol and review a cash secured put and a vertical? Okay, OGI. Not familiar with OGI. Or Gamigram Holdings, okay? And you are bullish on it, okay? So this stock certainly is interesting chart. I don't think I've seen a chart that looks like this in a long time. Very, very weak stock since mid 2019. It went from $10 to about $2, so about 80% cut on its price. And if you zoom in, the chart looks very similar. You have this series of lower lows, lower highs, and you have this channel here, and it looks like it might have just kind of broken out to the upside, and maybe you think that this stock is now going to rally higher. And you want to take a look at a cash secured put or a vertical. So let's look at a cash secured put first. So first of all, on a $2.50 stock, many times I'll tend to find that there's really not a lot of cash secured puts that you can sell. You can sell a June 2.5, right? Which is really the only put I think you can sell here, for 30 cents. So 30 cents on a $2.50 stock is 12%, right? So you're roughly getting a 12% discount on the stock purchase if you sold the cash secured put instead of buying that stock. So if the stock stays around 2.5 by June expiration, let's say it settles at 2.5 or a little below 2.5, you get a 30-cent discount on the stock purchase, which is a lot. That's 12% of the underlying stock price. So from that perspective, you may have a pretty, I would say, nice purchase here for a relatively cheap price, getting it for 30 cents less. Now, if the stock rallies, right, then what happens is all you keep is your 30 cents and you won't be able to own the stock. But then at that point, what you might want to do is you might consider buying a call. You can just buy a call here. So by selling that June 2.5 put, you can collect 30 cents, but you can take that 30 cents and buy a July 2.5 call. So that's something that you can do, is that buys you upside. So if between now and July, the stock takes off and goes up to $4, then you would get to participate by buying a call. I don't know that a call spread here works a lot here, because I think that, number one, you don't have a lot of options to sell above, and you're not going to get much in terms of premium. So even the $4, you only get 1 cent in premium. So I think you're better off selling that cash secured put on a stock that you seem to be bullish on. I would look at maybe that June 2.5 put, which collects 30 cents. Take that 30 cents. Try to buy a call here, only 35 cents if you get filled in midpoint. So you're basically getting this call for free. And if the stock rallies, you get to participate on that. And if the stock declines, you own the stock at $2.5 minus 30 cents. So you're really owning at about $2.20, which is about right here. You know, I would say that if you look at this long-term chart, the fact that this stock went from $10 down to 2.5, you know, owning at 2.5, if you really think that that's a bottom, it's probably not a bad price to own. But I will say this chart long-term does not look particularly strong. I know nothing about the stock. I don't know what they do. I don't know if this stock could very easily go back down to $1. I can't comment on that. That's your own view. The only thing I can say is that you do have what looks like a nice breakout here, but that breakout, in my opinion, may not necessarily last very long, because you have, in my opinion, a lot of resistance levels here. You have some resistance here, you have major resistance here, major resistance there. These are all going to be challenging levels for this stock to get above. You know, you get the small breakout, could get up to 3 and then just roll over. But, you know, that's more of a fundamental view. I don't know nothing about the stock, so hard for me to comment on that. AG, First Majestic, Silver. I think we've covered a lot of these mining stocks at this point. I think that's pretty much all that we've covered here. Is AG a symbol? I don't know if that's a symbol. Please give me the symbol and I'll take a look at that. Oh, FR. Okay. Let's see if I can load that. 1 second. I'll take a look at that, Donna. I'll come back to that. See if there are more questions. Okay, still a lot of questions and still a lot of names to get through. Let me see if I can try to get through as many of them as possible. We are coming up on time here. First Majestic, similar to most of the other ones, not as strong as Barrick Gold or any of the other mining stocks. You know, you have this major resistance level here around 140 or so that I do think you need to get above first. I'm sorry, 14 or so. You got to get above that before, you know, this thing can continue moving higher. Certainly is trading up against that resistance level, looking close for that breakout, but not quite yet. Hi, Tony. For option Greeks, should we also consider beta on top of this, on top of the usual delta, gamma, theta, vega? Because if delta is the option price change, then beta can give a sense for how much the market change can affect options price. Wallace, you know, the beta is already incorporated into implied volatility. So you don't necessarily need to look at beta. So the more volatile a stock is, the higher the implied volatility. The smaller the beta, the smaller the implied volatility. Now, the reason that I don't generally use beta, because the beta is calculated over 5 years of price return. It's a number that doesn't move very much. So you can have an option, you know, versus the implied volatility is calculated in real time and takes into market factors very quickly and will change very quickly. Look at XIU. The beta barely changed on that, you know, as the market sold off. So I would not use beta as, I think you're onto the right idea, but beta is calculated over 5 years of price history. and I just don't think it moves fast enough. Use implied volatility instead. It's a much faster indicator, and it implies, and it uses based on the option that you're actually trading. So right idea. I don't think I wouldn't use beta as my metric though. Okay, so I've tried to go through as many examples as possible. I do want to try to answer some of these questions before we wrap up here in a few minutes here. Mohammed is asking, what is a liquidity report? So liquidity report is simply just the list of symbols that are liquid. Why some stocks get excluded? Because they're not liquid. That's why they're excluded. So anything that's not on that list, be very careful about trading. Exiting a cover call early as a beginner. I thought if you sold a call, you had to hold it to the end. That is not true. I'm not sure who told you that, but with any option, there's no obligation at all, whether you're buying or selling, whether it's a spread or any type of strategy, for you to hold it to expiration. You can always close out any option prior to expiration. There's no obligation for you to hold it to the end. What is the minimum OptionsPlay score you want to see? I generally want to see a minimum of 80. Once it dips below 80, you get a red OptionsPlay score. So anything that's red is usually what I would avoid. What do you think about weed stocks? I really don't think much of them. I don't think any of them are really coming back. At the moment, Canopy, has a bit of a rally over the last few weeks or so. Maybe this might be the bottom here, but long term, this still does not look good. It's really hard for me to say. I do think that for something like Canopy, if it broke back above this $33 level, then I would certainly say that you have a bit of a bottoming formation here that has completed itself. But until it can get back above 30, I would say this longer term downtrend is still somewhat intact here. You do have a strong rally here that may be breaking it, but I wouldn't be surprised if this starts to fade and comes back into this broader long-term bearish trend at the moment. So I have not seen enough evidence from the chart or the fundamentals to suggest that this is starting to turn around just yet. Let's see. By bearish vertical, what do you mean? It means buying a put option. So let's go back to, let's say, TD, for example. A bearish vertical is where I'm buying. So here I'm buying just a $58 puts, which is a simple bearish strategy on TD. And I'm basically betting that the stock will go significantly lower between now and expiration. But instead of just buying the $58 puts, which cost me $4.65, what I can do is I can buy the $58 puts and then sell the 48 put against it and collect $1.07, which means that instead of costing me $465 to place this trade, it only cost me $358 to place that trade, which is a 358 divided by 465 means that it only cost me 76% of the cost to buy a put to buy the same bearish bet. So I'm basically risking about 25% less by buying a put vertical than just outright buying a put option. That's what I mean by put spread. How does the option price factor in dividend, which are upcoming? It already does. I don't have enough time to really get into the option pricing model, but it accounts for the fact that there's a discrete dividend coming up in the option pricing model, because the person who's selling you that option is factoring into the fact that if they are short that stock to sell you that option, that they have to effectively pay that dividend to the person who's long the stock, and they've already factored that into the price of the put option when you're purchasing a put. So that is how it's factored in. Options with wide bid-ask spreads are likely more difficult to close out, correct? Yes, that is correct. It does. I wouldn't say that it's more difficult to close out. It just means that you have to pay more to close out. So I think there's a difference between difficult and how much you have to pay, right? So in terms of liquidity, something that's less liquid isn't harder to get out. You just have to pay more to get out. You just have to pay more in terms of getting in. You have to pay more to get out, because every option has a bid-ask price. If you pay it that bid-ask price, you will get out immediately. It's just that other prices, for example, if you're trading BMO, you're going to have tighter spreads, which means you pay less. But if you're willing to pay the quoted price, you will get out instantly. So I want to make sure that that people understand, liquidity, right? When we talk about easy or hard to get filled, it's not a matter of easy or hard. It's a matter of how much do you have to pay. Should I buy back a cover call near expiration if the stock price has closed? If the stock price has closed once over the strike price and went back down by the expiration date. If the stock is below the strike price by expiration, you do not need to buy back the cover call. The names on the liquidity list fluctuate from week to week. They actually fluctuate from day to day. Some stocks will be included in one week, but not in the other. Would you trade those names if they show up in some weeks? I would trade them if they showed up, if they're fairly consistent in the week. If they fluctuate in and out, that means the liquidity is almost there some days and it's not there other days. But if they've made it to the list at some point, then generally speaking, I think that they're okay for trading. What do you think about leap strategies for long-term potential on stocks like BAMA rather than purchasing outright? So I will say, in this current market environment where you are concerned about long-term growth, you might want to utilize leap options. It's hard for me to say specifically about that one stock because I don't know how much the leaps are. But, the one thing about leaps is that they allow you to take that long-term view with a more leverage. They allow you to take that long-term view with leverage. So it really depends on whether it's a stock that you want to own for the long run, or it's just something that you want to take a short-term leverage bet on. If you want to take that short-term leverage bet, then I would use a leap. If it's a stock that you actually want to own for the long run, you want the dividends, then own the stock outright. Can you explain how to calculate support and resistance lines in more detail? The support and resistance lines are done using a fairly proprietary method that we've developed as traders ourselves. So unfortunately, I can't go into how we calculate that. Can we get in TMX website which have low bid-ask spreads? So we actually have a report for you guys that we built for the Tsx Liquidity List. So trade.optionsplay.com/TX CA Liquidity. And we give you a list of all the liquid symbols here. So as you can see, there are 38 very liquid symbols and 115 somewhat liquid symbols. And we show you the symbol, the earnings date, the implied volatility, as well as the liquidity here. This is available to you by going to trade.optionsplay.com/CA Liquidity. Whoops. So I will post this link to you guys into the chat window for those of you that want to take a look. And lastly, learned this the hard way, didn't close the winning trade on May 14th, expiration was May 15th, and the banks dropped. Had to roll over and sold put. We'll never forget your advice on closing winning trades at 75% or more profits. Well, Preet, I'm glad that you learned that lesson. I'm sorry that you learned it in that particular fashion. But usually these are the types of lessons that we never learn from listening. We usually learn by experiencing. Unfortunately, but I'm glad that you did get to experience it and learn that lesson. I agree with your bearish analysis on XIU, but OptionsPlay is not recommending any bearish trades. So I will say XIU, the options, the thing about XIU is that the options are pretty far apart from a percentage perspective. Looks like we do have some bearish trades here for XIU. So you can go to XIU, click on I'm bearish, and you'll see these XIU bearish trades. And just to be clear, the bearish put vertical is not necessarily for a big move. If you're expecting a big move, you're better off buying the put option. Just the put option costs almost twice as expensive as the put spread. So be careful there. You are risking substantially more, and that's why it has a relatively low OptionsPlay score versus this is a very high OptionsPlay score because this is cheap, this is expensive. So with that, that covers what I wanted to show with you guys here today. I'm glad that we were able to go through so many different examples of different stocks and show you how I would utilize options to play these directional views. I was really also happy that I was able to share with you guys how I view whether a trade is expensive or not by just taking a look at the option premium divided by the stock price is usually a very good quick back of the envelope calculation to understand, are these options cheap or are they expensive? I usually try to limit my risks to 4 or 5% of the underlying stock price. When I start risking 7, 8, 10% of the underlying stock price, that's when it becomes too expensive for me. So this just gives you a little bit of insights into how professionals utilize options to take our directional views and thoughts that we have in the market, but more importantly, how we do so with risking a small amount of capital. Because at the end of the day, no matter how good of a trader you are or how good you are at predicting the markets, you're going to be wrong from time to time. And it's really important that when you're wrong, that you're limiting the amount of risk in your portfolio so that you have enough capital to trade another day. If you risk too much of your account and you blow it up, guess what? That's game over. And that's what you want to avoid at all costs. And utilizing options is really one of the ways to help you minimize risk. And that's really how you should think about options as a tool that allows you to take your directional views, whether you're bullish on energy, whether you're bearish on banks, whether you're bearish on the gold miners or whatever it is, to do so in a way with the least amount of risk possible. And that's what I'm hoping to show you guys here today. So with that, I want to thank everyone for taking the time out here this afternoon and participating, providing all of the different examples and stocks that you wanted to take a look at and all the questions that you have. I hope I'm able to answer as many of those questions as possible here today. But again, this session is recorded so that you can come back and review this, especially for those of you that had specific names that you wanted me to go over. Watching the recording, seeing how I drew the lines on the chart, how I utilize specific expiration dates and strike prices and option strategies, I think are really important for you to use as examples. So we'll send that out to you as soon as we're done here today. And I hope that you guys have a great afternoon. I'm really looking forward to starting the next course with you, where we're going to talk a little bit more of some advanced strategies and go over some of those topics with you guys beyond just the beginner stuff. And then we'll do this all over again, do another Q&A session with the live market analysis and go through symbols and really just spend the time making sure that you guys are comfortable before we move on. So thank you so much. I hope you guys have a great afternoon, and I'll see you guys next time.